Hey, we're coming to you from Full Global Headquarters in Alexandria, Virginia. I'm Chris Hill, joined by senior analysts Ron Gross and Matt Argersinger. Thanks for being here, guys.
Always a pleasure, Chris.
We're talking dividend stocks. We're going to be taking your questions, and we also, to get you started, we've got a free dividend investing guide. It includes 3 stocks. You can find it at fool.com/payme, because that's what dividend stocks do. They pay you.
Hopefully.
Ron, let me start with you. Why do companies even pay dividends in the first place?
Good question. Companies pay dividends typically when they believe they've gotten to a point in the maturity of their business where they can generate excess cash that isn't necessary to reinvest back into the business. So typically more mature companies, but ones that do generate relatively stable amounts of cash. And when they find themselves generating that excess cash, one of the things they can do is pay it to their shareholders in the form of a dividend. The other thing they typically can do is buy back stock as well. So that's why you typically see companies, not early stage companies, ones that are more mature, generating excess cash with a relatively solid business model, returning some of that to shareholders.
Well, and Manny, there are a lot of ways for us as investors to evaluate company management. This is one more way, because once a company starts paying a dividend, we want to make sure they have a good track record and sustain it, not just quarter over quarter, but for years.
Sure. I mean, it's one thing to have excess cash to be able to pay a dividend, but you want to make sure the company you're looking at always has enough excess cash to pay that dividend. And so companies with high cash flow, good balance sheets, those are the ones that are generally paying dividends, but you want to make sure that those financial strength metrics stay in place. And so, over time, if you own companies that pay dividend, you generally want to see that rise over time, and companies that manage their financials well, manage their balance sheets well, should be able to grow the dividend over time. It's a great thing for investors.
Yeah, and this is really about management's ability to allocate capital. If management can earn a higher rate of return than just returning the cash to you, as a shareholder, we would theoretically not want them to pay a dividend to us. We would rather have them reinvest that money in the business to help growth. If you trust management to be able to discern when the time is that is not the case, where that excess growth is not available to them, then let's get that dividend.
Not to get too deep into the weeds when it comes to math, but what should investors be looking for in terms of calculating the dividend? Because the obvious thing that hits you is just the amount. Like, well, this is what we're paying every quarter or every year.
Simple dividend yield formula, what percentage yield you're getting is the 12-month dividend payout in dollars divided by the stock price. And that will get you the typical dividend yield that you often hear folks talk about. The standard S&P 500 dividend yield is typically around 2%, a little bit higher, a little bit lower, depending on what year you're looking at. But that's clearly one thing investors that are interested in income investing should look right towards.
And then I'd say after that, look at the payout ratio, right? So it's one thing that you've got the yield, but what percentage of that dividend is of the company's earnings? So you can look at a company's earnings per share. Let's say the earnings per share are $2 per share. That's an annual number. If the dividend is $1, that means it's a 50% payout ratio, which is probably roughly average of what you see across industries when it comes to dividend payout ratio. As soon as that gets up to 80, 90% of the earnings, you might say, well, can this company really sustain that dividend at the current yield if earnings were to dip? So just be aware of that kind of payout ratio over time.
Yeah, and not only can they continue to sustain, but they continue to grow. And the likelihood is no if you're getting up towards that 100% payout ratio. There are companies that for short periods of time will pay out more than their earnings. They'll pay more than 100%. That clearly is not sustainable, but it can happen from time to time.
And you want the earnings to hopefully bounce back then if you're looking at a company, maybe a cyclical company that's having earnings shortfalls, maintain the yield, but maybe those earnings are going to bounce back when the economy bounces back.
Well, and we've seen examples just over the past couple of years of like big, well-known companies. General Electric comes to mind, where they slashed their dividend. But from a management standpoint, even though that may hurt, particularly if you're a shareholder, that was probably the right move for that business.
Probably, for sure, the right move, but also painful nonetheless to an investor who is looking to that stock for income. But I do think it's important to note that even if you are an investor looking at a stock for income, this whole thing should be about total return. All investing should really be about total return, which is your dividend yield plus hopefully the appreciation in the stock price. That's really our goal here. If you buy a stock just to get a dividend yield, but the stock goes down, you're not really helping yourself. You're not getting, I think, the goal that you're hoping to attain. So think total return, not just yield.
And I actually sometimes don't mind if if a company takes large, if something has happened to the business where they have to change or pivot, or maybe they made a huge acquisition and they're digesting that, the dividend, a lot of investors think it's important, but in terms of capital allocation, as Ron talked about, it's probably the third or fourth thing a management team should be thinking about is whether to sustain a dividend. If the business needs cash, if there are higher returns that can be earned by investing in the business or doing something else, they should do that and not worry about angering a lot of investors by cutting the dividend.
All right, we're going to get to your questions in just a couple of minutes. Also, these guys have some stocks you can put on your watch list if you're looking for some high dividend payers. We talked about sort of the ability of companies to sustain the dividend. We should probably spend a minute talking about dividend aristocrats because, it's both worth mentioning and admirable that there's a small group of companies out there that have not only sustained their dividend, they've increased it every year for 25 years or more.
Very impressive. By definition, these are companies that are in the S&P 500. I think there are 64 of them at last count that have been able to raise their dividend 25 consecutive years. Very impressive. These are very large blue chip companies that generate gobs of cash flow and sustain that generation.
It's not all upside. I mean, if it were nothing but upside, that would be a little sketchy probably. Maddie, you hear when it comes to investing in dividend payers, one of the cautionary phrases is always, don't chase yield. What should people be thinking when they hear that phrase? Because, we just talked about the yield and how it's one metric to look at, but there can be some risk there.
Oh, of course. So when businesses get into trouble, their stock prices tend to fall, right? And so automatically, if a company is paying a dividend, their stock price falls, well, the dividend yield is going to go higher because it's just a higher percentage of the stock price. The problem is now a lot of investors will rush in thinking, oh wow, look at this stock, it's paying an 8% dividend yield, and that's incredible. I can just buy the stock and I'll get 8%. Well, that can be a red flag if a yield starts to get that high. If it's a regular business, that probably means the stock price has fallen, the business is in a bit of trouble. There's a high likelihood that dividend is going to be cut, and so anytime you see yields like that, be cautious. Make sure, again, we talked about the payout ratio. Make sure that the earnings are justifying that payout. Now, we could be in a bear market. The market could be down 15 or 20%. Maybe yields will rise, and so maybe there's a reason why that yield is so high. But just make sure once yields get that high, the business itself is sound and can sustain that yield.
Yeah, one final plug for total return. That's where you really want to look at, does this stock have the ability to appreciate over time, or is this company in trouble? Because just buying a stock at 6 or 7% yield is not the end of the game.
Well, and you can understand how people might fall into that trap. If you're just running a screen and you're just looking for yield over a certain percent, you're going to come up with a list.
Oh yeah, and I mean, we know these days, interest rates are extremely low. I'm not getting anything in my bank account. I'm not getting anything really by investing in bonds. And so when I start to see stocks with yields 4, 5, 6, 7%, I get pretty excited. And I should be, but I also should be cautious about investing in companies that might not deliver the total return that Ron's talking about.
All right, let's get to the stocks. For folks who are looking for sort of the high yield payers out there, what do you got, Ron?
Let's go with 3M. MMM is the symbol. Large diversified manufacturer. Post-it notes, Scotch tape, but lots of other areas. Healthcare, industrial, transportation as well. Currently yielding 4%, pretty strong. It's a dividend aristocrat, and it's increased its dividend for 62 consecutive years.
Wow.
Very impressive. In the news a lot lately because they manufacture the masks used to protect against coronavirus, but that is not a reason to buy the stock. I want to caution people against that. It's still a very small part of their business. The company's actually been struggling a little bit lately. The stock is down a little bit. They're undergoing a restructuring. They're moving into healthcare. They're trying to really firm up the business. This is not a home run stock. This is not going to double and triple over time. This is a blue chip, large industrial company, but at only 16 times forward earnings, you're getting a stable, well-diversified company that's going to continue to raise that dividend over time. Adjusted payout ratio is about 60% right now, which is a little bit high relative to their history because they're struggling just a little bit, but 60% I think is still fine for a company of this stature.
Well, and 3M is sort of the classic blue chip dividend payer that you and I grew up with. I mean, now that Apple is paying a dividend, you look at the total return of that stock over the past 12 months. It's really been amazing to see, and in some ways may skew people's expectations of what a dividend payer is, but 3M is one of those classics. Maddie, what do you got?
Well, I wanted to go with a company called Ryman Hospitality Properties. The ticker is RHP. It's a real estate investment trust, owns a lot of interesting real estate assets, but just given the challenges to hospitality out there right now and that are going to be happening over the next several months, I decided instead to go with a company called Physicians Realty Trust. The ticker's DOC. This is not a dividend aristocrat or a big company. It's a small company, actually. It's $4 billion market cap, but over 250 properties in the medical office space. Over 90% of those are single tenant or multi-tenant outpatient clinics and smaller office medical offices, so not hospitals. There's a big trend towards outpatient care in the U.S. In the past, 70 to 80% of people generally would go to a hospital or an emergency room if they had, if they had to get something done or if they had an emergency. Nowadays, these outpatient clinics that specialize, they're located in smaller neighborhoods and things like that, becoming a much more popular way for patients to seek medical care. So they're on the right trend there. Really impressive DOC, 95% occupied across their buildings, triple net leases for most of the leases, which means the tenants cover things like taxes, insurance, and maintenance. And so Physicians Realty Trust is just the landlords. You're investing in the landlord of all these properties. And it's one of the least cyclical sectors in the marketplace, healthcare, right? And the company is growing nicely, pays almost a 5% dividend yield.
All right, thanks for watching the video. We really appreciate it. If you can give us a thumbs up, it helps other people find the video. We always appreciate that. And again, go to fool.com/payme. You can get our free dividend investing kit. Comes with 3 stocks on top of the 2 you just heard about. Let's get to the questions that are coming in from the audience. First up from Harris, and you touched on the coronavirus, Ron. Harris asking, with coronavirus fears and outbreaks, is now really a good time to even buy stocks? Perfectly reasonable question given the volatility that we've seen this week and the drop that the market has had over the last couple of weeks, last week being the worst week that we've seen since 2008.
Interesting times, for sure. And I don't want to be glib because I know it's painful when people see their stocks go down. But in a real sense, I think it's always a good time to be investing. And if you take that tact, you'll invest in good times, you'll invest in bad times. Over years and decades of being an investor, you'll buy when stocks are high, you'll buy when stocks are low, but you'll be constantly putting money away into the greatest compounding machine we know of, which is the stock market.
Yeah, I can't top what Ron just said. I will just say, I think we're all sort of trying to understand what are the implications of coronavirus. Certainly, we can say from an economic standpoint, the implications are going to be huge. And so especially for a lot of sectors, if you think about hospitality, which I mentioned earlier, retail, you can imagine a lot of discretionary spending is not going to happen over the next several weeks and months. And so I would certainly be cautious. If you had some money on the sidelines, maybe co-measured into the market, come a little bit in, but then look to add money later. But to Ron's point, I would just say it's always a good time to buy good companies today or 2 weeks ago when the market was at all-time highs.
Question from Johan, who asks, should we buy American Airlines stock now? In general, should we be buying airline stocks? I mean, that goes to your point, Matty. I mean, hospitality and yes, travel stocks. I mean, they're the cruise line stocks, which have basically been cut in half. Over the last couple of months. And the airline stocks are taking a big hit as well, as not just individuals rethink their vacation travel plans, but a lot of businesses out there are saying, we're putting a moratorium on business travel. We were
at the Million Acres, which is the real estate company here at the Motley Fool that I work for. We were supposed to have an event in San Diego at the end of this month. We had over 200 members coming. We canceled the whole thing a few days ago. And we're just one small company, the Motley Fool, right? And that's happening across industries. With the airlines, I'm sure Johan might have pointed out American Airlines because it's probably been hit the hardest. I own shares in Delta Airlines because A, they have a stronger balance sheet, better fleet, in my view, better management team. And so, I think you can play favorites, but it's not going to be good for the airlines at all for the next short or long while.
Agree. I just recently released a new portfolio in the total income service that I run, and I did include Delta, thanks to a little consultation with Maddie and some other investors, in that portfolio because the valuation is strong and puts, I think, it in our favor, the odds of success, plus the balance sheet can withstand, I think, whatever comes our way. But, there's 2 sides to every trade. I have a colleague on the investing team who's buying the cruise lines. It's too cheap to pass up. But on the other side of that trade, there's a lot of folks selling.
Question from Paul, who asked, do you have any thoughts on Tanger Outlets? Looks like an amazing yield, but the stock keeps dropping. To your point about retail, Maddie, Tanger Outlets, we got one just across the river here over in National Harbor. What do you think?
You know, that's one of those ones where the yield is probably too good to be true right now. There's probably going to be some pain or some cutting there. Again, with shopping centers, even a strong one like Tanger, which has great tenants, great credit quality tenants, I just think the traffic at those outlets is going to plunge. There's just no doubt about it, and we already know what's happening to retail in terms of the headwinds these days, just sector-wise with e-commerce and things like that. And so this is just another really bad piece of news for companies like that. I would tend to probably lean outside of retail if I'm looking at real estate or looking at dividend yields. And I mentioned a couple earlier, but I'd personally stay away for now.
Yeah, I'll just mention, I agree with that. I know another company that Maddie likes is a Stag Industrial, STAG. It's a real estate investment trust, as are many of the companies that we've been talking about here, which by law has to pay out 90% of their net income as dividends. So they're typically relatively high dividend payers. Stag's at about a 5% yield right now, which I think is pretty safe.
I think it's really safe, and I'm glad Ron mentioned Stag. Talk about the opposite of what's happening to retail. Stag owns distribution facilities, warehouses. They're really sort of riding the e-commerce wave in a lot of cities around the country, where traditional retail is going the opposite way. So with Stag, I think you get a double punch of stable business, good dividend yield right now, industrial tailwinds with e-commerce and things like that. So I like the pick.
Question from Dave, who asks, how many stocks do you have to own to actually get the benefit of dividend investing? There's no magic number, but in general, we like to see people diversified somewhere, at least more than 10 stocks.
I would say, yeah, probably 15 to 20 stocks. The academic literature is a little bit mixed on how many stocks you actually need to get diversified properly. I think 10 is probably too low for most investors, because that's a 10% bet on each company on average, probably a little bit much. So 15 to 20 is right for me, and that's regardless of whether you're a dividend investor or not.
Question from Phil, who asks, what is your opinion on Wells Fargo after everything that has happened? Boy, it has been, from a reputation standpoint, a pretty rough few years for Wells Fargo. When you think back just a few years ago, Maddie, the sort of the fake account scandal, and they're still paying the price from that.
They are, and it just seems like when all sort of the bad apples have been have been taken out of the business, there's just another one that pops up and rolls in. And I don't have a good opinion on Wells Fargo. I would say the financial industry, like a lot of industries, is facing a lot of disruption from a lot of places. Fintech and companies that can embrace it. If I look to companies like JP Morgan, maybe a little more, or companies like Square, if you're looking in the financial space. I know Wells Fargo is a well-known name, and I don't even know what the dividend yield is. I'm sure it's
about 5%.
Probably paying a nice dividend. But you have to ask yourself, what Ron talked about earlier. What's the growth potential for the business? It might be paying a nice dividend yield, but with all the problems, the poor management they've had, the ability to grow that business, it's a behemoth business. What's your total return going to be from investing in Wells Fargo? I bet it's not going to be as great as looking elsewhere.
Agreed. Under 10 times trailing earnings at a 5% yield, I could see why it's enticing. Now, banks don't typically trade at high multiples anyway, but this looks, just on paper, that it could potentially be cheap. It doesn't interest me anyway, just based on what they've been through, and I don't have confidence yet. I'd continue to review it as time goes by and see if restructuring takes hold.
I was just going to say, if you're willing to wait a couple of months, I'm sure Wells Fargo is going to come up during the Q&A at the Berkshire Hathaway annual meeting, one of Warren Buffett's biggest holdings. Roger asks, I have only $500 to invest right now. Should I invest in index funds or individual high-yield dividend stocks? I mean, I'll just say that we're always big fans of index funds, particularly when you're just starting out, but we're here talking about dividend stocks.
That's true, and you could invest in an index fund like this SPY, the Spiders, and get yourself around a 2% yield at the same time as getting that instant diversification that you get from an ETF, especially an index ETF. That's probably the way I would go. Get yourself a nice little diversified portfolio just right off the bat, and then as money bleeds in, then you start to buy individual stocks.
Yeah, I agree. With $500, if you're just starting out, putting all of that in one stock just seems a little too aggressive. I agree. Start with indexes, diversify over time as you get more cash.
If income and yield is a primary concern, there are other ETFs that pay higher yields than an S&P 500 index return. You can get some as high as 3.5%. If you look at the Vanguard High Dividend Yield Index, which is VYM. So there are others. S&P 500 is obviously one of the most well-known.
I'm not sure the ticker, but I think there's even a ETF that does the Dividend Aristocrats.
That's the SDY or the DVY.
There you go. Look at this guy.
Do you guys have a personal preference of what you do with the money that you get from your dividends? I mean, some people like to just take the cash and compile the cash so they can deploy it whenever they want. Others like to just reinvest it and just get more shares.
I'm more the former. I like to get the cash so I have control over it and can reinvest where I see fit. I know DRIP strategies are really popular with high dividend paying stocks, so that the brokerage account you're using automatically reinvests the dividends by buying fractional shares or more in the stocks you own. That can be a great strategy if you love the business you're invested in and want to build your position over time in a very low cost way.
Personally, I usually just get them reinvested. It's easier than having to worry about redeploying. But it's funny because professionally, I usually take them in cash and then like to redeploy them. Play maybe a little bit of games there with cash management. I did want to make one correction. The DVY is a BlackRock's dividend index, not a Dividend Aristocrat one. The SDY is the Dividend Aristocrat.
We got a couple of questions related to oil companies. Zach asking, what do you think of ExxonMobil relative to Chevron and some of the other oil stocks? Another viewer asking, is now the best time to buy oil companies and banks? As you said, Ron, I mean, banks never really trade at a very high multiple. Oil stocks, well, they're certainly cheaper than they've been in a while. I mean, really the past decade for ExxonMobil, which has just been a behemoth performer for so much of its time as a public company, really the past decade, it's basically done nothing.
No, I mean, for years, you would find ExxonMobil as on the top, number one in terms of the biggest companies in the world. And to see the amount, the billions in market cap that ExxonMobil and a lot of the big oil majors have lost. I don't have good, strong, smart opinions about the energy sector. I would just say the oil and gas space in particular, to me, just based on other industries that I follow, seems to be really, in the pinnacle of disruption going on. I mean, if you think about the rise of renewables, what's happening to the transportation industry, or what will happen in the coming years, it's going to be a tough place to make a lot of money. And if oil prices stay where they are, most of those companies are not earning a profit on the barrels they extract. And gas, of course, which is a big component, natural gas is trading multi-year lows. And there's just so much supply of it.
Yep. I own Exxon, probably shouldn't. Too lazy to have sold it. That sector doesn't interest me. Financials interest me, but I'm not good at analyzing them. The balance sheets are a little bit black boxy, for lack of a better word. You can't really look underneath them and understand them in certain cases. So if I do invest in financials, I typically do it through an ETF to get diversified.
One viewer asking, what are the top 3 REIT types we should have as a base?
REIT types, I'm guessing that he means property types. Okay. Well, I would say start with probably the multifamily REIT, the Avalon Bays of the world, just as an example. The apartment sector of the country, I think, is in the strongest position in terms of real estate. We just don't have enough apartments right now in most places for people to live. So the returns investors and managers, development companies are getting by building more apartments, there just seems to be a lot more runway there. So start there. I would then probably look at the industrial side of REITs. Just a lot of positive momentum. We talked a little bit about that earlier with Stag Industrial, but the e-commerce tailwinds just keep pushing, and not only that, things like cold storage, just warehouse and fulfillment, last mile. There's so many angles where distribution type real estate is strong. And then after that, I would say start looking at the hospitality space, only because it's been beaten up so much, and so that could be the speculative triad, part of the triad, where I'm putting a little money to work because Hospitality can be great if you buy the right companies. It's just very cyclical and seasonal. Right now, the valuations look pretty good just given what's happened in the economy, but one that could bounce back pretty strongly if things turn around.
I'll throw in a plug for the digital revolution and companies, REITs that own cell towers. American Tower, Crown Castle come to mind. Some pretty interesting plays there.
Yeah.
Well, and we talked before about how you want to allocate your portfolio, whether it's dividend payers across the board or not. And to the point you made, Maddie, I think in general, we like to see a little bit of the portfolio allocated towards the more speculative, whether it's growth stocks or something else.
Right. I think there's always, even in REITs, which tend to be a sleepy, boring part of the market, there's definitely some speculative plays. There's even a well-known, well-tracked, if you're a younger investor, big REIT that invests in marijuana properties, for example. So there's areas of real estate to play, certainly. And so I think there's always room for that. If I'm looking at my total REIT portfolio, the 20-30% to be in the speculative growth area. The rest I want steady, high dividend payers that are kind of the ballast for the rest of the portfolio.
Question from Rolly, who asks, I'm a brand new investor and my plan is dividend investing. What is the single best advice you can give me?
Okay. First, I would be curious as to why the goal is dividend. I don't know enough about age, status.
I'm guessing it has something to do with money.
We like money.
Pay me.
The most important thing to do is, if you're focused on dividend investing, is to buy stable, relatively mature companies that consistently generate profits and will pay that out in more increments each year. Will continue to grow those dividends.
Yeah, and what's interesting is it's not the case for the last 10 to 20 years because of what's happened in the stock market. But if you look back at like the past 100 years in the stock market, dividends are responsible for more than 50% of the total return of the stock market. And so if you were investing in dividend-paying companies, by default, you're investing in stronger companies anyway, companies that have strong balance sheets, generating good cash flow, especially if you're in the aristocrats that can do that year in and year out. That's a great place to be. There's no reason that can't be the core part of your portfolio. And then you have speculative sleeves elsewhere with technology or biotechnology or things like that to play more growth.
Question from Medrick, who asks, what do you think about AT&T as a defensive dividend stock, also with 5G coming? I'll just say, as an AT&T customer, they do an amazing job of making it really easy to pay your bill. And you know what? For a sticky business like your cell phone carrier, that's a good move. That's a smart move on their part.
Yeah, I haven't really dove into AT&T that much. I own Verizon as part of the 5G play right now, and that's a pretty good dividend stock as well. I don't know, do you have any thoughts?
I would just say this. I think there's a little bit of a battle going on right now between, say, your AT&Ts and Verizons versus your Comcasts and your more dedicated broadband players. I do think wireless and with 5G is going to be a really big competitor in a lot of ways, and AT&T and Verizon are certainly the big asset players and owners in that space. And so the value, I've looked a little bit at AT&T, and the valuation looks better and better to me given what else is going on in the business.
Last question from Annie, who asks, what is your opinion on Disney Plus, and do you think it would ever compete with Netflix? Do you think Disney's looking attractive at the moment, or would you hold off? As a Disney shareholder, it's certainly cheaper at the moment than it was a couple of weeks ago. So you got that going for you.
Yes, and a good question. I too am a Disney shareholder, have been for probably over 15 or 20 years. I think Disney Plus is a strong offering. I think it will compete with Netflix as well as the other streaming offers out there. There are probably actually too many right now, streaming services. We're perhaps going to see some consolidation down the road, but Disney Plus, I think, is one of the strongest from a content perspective.
Yeah, I mean, I looked at Disney the other day, and it's something like 10% below when Disney, brought out Disney Plus back in the fall. So really, that whole premium that it got after doing Disney Plus and the success that it had has gone out the window, and it's down, way from its 52-week high. And I would say a lot of that's legitimate concerns about cruise lines travel, parks being shut down, certainly. But gosh, certainly one of the premier best companies in the world, down 20-25% from its high. something to maybe take a look at.
Obviously, some management shifts going on there as well. Bob Iger kind of kicking himself up to the executive suite as executive chairman. I still think the company's in pretty good hands.
Well, and you think back to 2008, 2009, not perfectly analogous to what's going on with the coronavirus, but in terms of the Great Recession, people pulling back on the travel. Disney did a good job pulling the levers that they could to still get people into the parks.
Right, and there's the wonderful thing about Disney, there's so many parts of the business that can work when other parts aren't working. The in-house, in-home entertainment with Disney Plus, all the the studios, the films. I mean, all that stuff is going to hurt a little bit, but not nearly as much as other parts of the business.
All right, Matt Argersinger, Ron Gross, guys, thanks for being here.
Thanks, Chris.
Thanks everyone for watching. Thanks for giving us a thumbs up. We really appreciate it. And again, go to fool.com/payme. You can get our free dividend investing kit. Includes 3 stocks, everything you know to get started in dividend investing. I'm Chris Hill. Thanks for watching. We'll see you next time.
I'm cashing in on triple coupon. Soup Kitchen's calling, saying the soup's on. I sing for my supper and get my groove on. I still know how to have fun. I need checks, I need balances. Life's a mess with financial challenges, checks and balances. When things get tough, do you do it for money, or do you do